So today we're going to talk about another key principles on wealth management, which is diversify. As the saying goes, don't put all your eggs in the same basket. So we're going to see how diversification of your funds, of your money, of your investments helps it not only grow faster but also helps in mitigating the risks that are involved while you're investing. So every investment is a risk, and depending on how you invest money, you have a certain risk profile, and depending on your risk taking capability, the money needs to be diversified so that it is in proportion to what you're capable of taking. Ask yourself these questions. Are you too relied on one investment and it has backfired? Has it happened ever in your life? This is very typical with overexcited people who go on to invest in stocks and at a certain point in time realize that they have overinvested, and it's difficult to get back even the money that they had invested. Forget about the returns coming from it. Should you look for stability or better returns? Now, this is one of the key questions that each investor has in his mind. How much stability, how much returns, what's the balance that they should strike? Debt-based instruments typically give you more stability, while equity-based instruments give you more returns. What you should be opting for is the question. What combination is right for you, depending on your age, your risk-taking ability, and so on? Many times you're not sure how much to diversify, when and where. Should your diversification change with time in your life, with age? So for an individual who is 30 years or for someone who is 70 years old, are the diversification needs different? Obviously they are. So these are some of the typical questions which tend to come in your mind when you tend to invest money and you're not sure whether you should put it in fixed deposits, recurring deposits, or more debt-based investment options, or you should go for something like mutual funds and equity and stocks, which are tending to give more returns and in a certain point of time. So if you have been stuck with any of these questions, this is the module for you. So what is in it for you? You're going to understand the sixth wealth creation principle, which is diversify. We've already studied some of the other wealth creation principles. As you can see here on the slide, the amazing power of compounding, paying yourself first, starting early, getting started, sharpening your financial saw. And today we're going to talk about diversification and how it applies in every aspect of life, including wealth management. And diversification is really, really important as far as the growth of your wealth is concerned. And it has a lot to do with what investment tools you're opting to really get the best out of the investments that you're doing. Again, going back to the same examples, example where you are the CEO of your life and these assets are your employees. So what kind of returns, what kind of productivity these assets have, how much do they give you back? It's so important to understand all this. This is an age-old story. So there was a teacher in a class, and he had asked his children to tell some stories about anything, any topic which has a moral. And one of the guys in the class stands up and says that I went down to the hen house and there were 12 eggs. And I was very excited to see that, so I told my mom, we've got 12 chicks. But ultimately, when the eggs hatched, we only got 6. So the teacher said, fine, so what's the moral of the story? So the student said that the moral of the story is don't count your chickens before they hatch. So we should not get overexcited, start counting unrealized returns, returns which have not yet matured, which you may get a false impression of getting high returns, but you may not have still realized them. That's a good one, said the teacher. And any more students? So there's another guy in the class, a smart one, and he stood up and said, yes, I also have a story to share. Well, the teacher was happy and said, okay, go on. And this guy said, I also went down the hen house. I also saw 12 eggs. I did a trick. I put them all in my basket and excitedly ran to the house. But as I was running, I tripped and the basket fell down and 10 of the eggs broke, leaving me with only 2 of the eggs. So the teacher asked, okay, what's the moral of the story then? So the student responded, don't put all your eggs in one basket. Unexpected events can happen in life, and they're very likely to happen in everyone's life at some stage or the other. Life will give you surprises, and if you're not prepared to meet it, you will be in a negative state of position to really handle all that. If all your investments are done on one or two investment options, your risk goes up, and it is important that you diversify to reduce that risk. So diversification actually tends to be a very good mitigation strategy if you are on a high risk profile path. Where does diversification fit in? There are multiple investment classes that we have. So if we have surplus money, we can invest it in certain debt-based investment options like fixed deposits, recurring deposits, debt-based funds, government bonds, and so on. We could also invest that money in equity-based investment options like equity-based mutual funds, direct stock equity, and so on. You could also invest in real estate. In fact, nowadays we're going to very soon have real estate investment mutual funds also. And we could also invest in commodities, and typical example is gold or silver, and gold being one of the biggest commodity investments that Indians are known to doing. Now each of these investment classes have a different risk profile. Each of these investment classes have provide you different kind of returns, and each of them have their own advantages and disadvantages. So depending on every individual, you may have a different allocation of funds to each of these investment classes. And again, you may or may not invest in each of the classes. It all depends on what you're looking at. Are you looking at stability? Are you looking at better returns? Are you looking at liquidity of your money? Are you looking at just countering the inflation, and so on and so forth? So we need to be very careful about our allocation of investments to any of these asset classes, and we need to scientifically calculate how much is the right mix to invest in each of these investment options. And you'll definitely need the help of a good financial advisor to work out what works for you well and accordingly take decisions. How important it is to diversify? Now, for example, if one of the portfolio is too heavily invested in debt-based investment tools, for example, if fixed deposits and recurring deposits and provident funds and public provident fund and bonds, etc. This is very typical of salaried individual who really doesn't have time to think beyond these debt-based investment options, or even commodities like gold, silver, etc. Then all these you can get the luxury of stability of money to a large extent, but they're definitely going to hamper your return on investments. And as we studied in one of the earlier modules, return on investment is going to be one of your biggest levers to really build great wealth. And if our investments start hampering our return on investments, then we got to really think whether that's all we need, or we really still need to build great wealth, and for that we need to diversify. Too much of investment in real estate can take off liquidity from your portfolio. Liquidity typically refers to how easily you can take out money from a particular investment. Now, for example, in a fixed deposit, it's pretty simple. You can, at any stage of the fixed deposit time period, you can decide to terminate your deposit, and the bank would be happy to pay you back your money as on that particular date, with whatever pro rata based interest that they will calculate. Some banks may offer you penalties for premature withdrawal, but then those are very minimal, and most of the banks today do not even penalize you for premature withdrawals. But imagine that if you're invested in real estate completely, your liquidity is definitely at stake, especially when the market is not really doing good and may be difficult to find a buyer, and that's where you really tend to lose out. And if you can't sell at the right time, it's difficult to invest at the right time also, because You want to take out investments from a particular investment class and put it into another because you see a growth potential there. But since the liquidity in real estate is low, it might be difficult for you. Too much investment in equity-based investments like stocks and mutual funds can increase your risk beyond what may be acceptable to you. Now, at the age of 70 or 80, you may not be really looking at a long-term horizon of 10 or 20 years to really pay you good money, but you may be looking at more of stability. So it depends on a lot of factors, and too much investment in equity can definitely increase your risk. So when you're in equity, you are basically an equal partner in a particular organization or a company whose stocks you've purchased. And it really depends on the owners or the board members who are running the company, and your returns are truly dependent on them, and so there's a big risk involved here. So any profit or any loss is equally shared by you, which is unlike a fixed deposit where you're destined to get definite fixed returns over a fixed period of time. So diversification is critical, but understanding what are the benefits and what are the drawbacks of each of the investment classes, you need to think how to diversify. And again, you must take help from some financial planner, somebody known to you who can really help you diversify and plan your portfolio well. What do we mean by the right mix? And how does it typically look like? Now, the various thumb rules that are prevalent in the industry today, and the right mix of every portfolio depends on various factors, and we'll be limiting a very few here, but there are various factors involved to decide the right mix of your portfolio. For example, the portfolio mix depends on your age. So if you are 20 years, or let's say 25 years, the industry thumb rule is that 100 minus 25, which is 75. So 75% of your portfolio should be in equity if you're 25 years old. So when you turn 45, when you turn 50, or let's say when you turn 60, only 100 minus 60, which is 40% of your portfolio should be equity. So your equity proportion keeps going down with your age. And this is again a thumb rule. There is no hard and fast rule here. If you're still capable of taking risk, you must continue. But in general, this is what the industry adopts as the thumb rule. So which also means that you should carefully be monitoring your portfolio and seeing how your different assets classes are performing, and switching funds between one asset class to another. Maybe once a year, you should definitely be monitoring your portfolio and seeing if things are working as per the right mix that you want it to work. It also depends on your risk-taking capability. So a high risk-taking capability can offer high returns. Let's say, for example, there is a salaried individual who is the only earning member of his family, then his risk-taking capability goes down. While if both husband and wife are working, the risk-taking capability of one of them goes up, so you can take more risks. So that's how it all depends on your specific constraints that you're working with. So your risk-taking capability can really differ. Time you can spend taking care of your portfolio, and a lot of people say they do not have time to really manage their portfolio, which is fine. And that also decides whether you should go for mutual funds or direct equity. People who do not have time but still want higher returns and are capable of taking some level of risks, are ready to invest for long term, they should be investing in SIPs, which is systematic investment plans of mutual funds. But people who have some time and can really spend time and effort to analyze and invest and monitor, direct equity is the way for them, because although they'll be spending more time and actively monitoring it, the returns that you can get from direct equity are far, far higher than what you can get from SIP mutual funds. So typical returns from SIP mutual funds could be 20% per annum, while from direct equity could be 60-70% per annum. So that's the kind of difference we're talking about. And again, it depends on what risk-taking capability you have, how much time you have, and so many more factors that define where you should be investing your money. Okay, so this slide gives you a sample mix of a typical portfolio. For someone who is healthy, aged 35, a typically diversified portfolio should look something like this. So there's a debt-based asset class, which at a high level composes of fixed deposits, recurring deposits, bonds, etc. Typical allocation is not more than 5%, and on debt-based mutual funds it's around 10%. Now the difference between these investment options like fixed deposits or debt-based mutual funds, I mean, at a very high level I would say debt-based mutual funds are capable of giving you better returns, although they're not guaranteed. It's again a reward versus risk within the debt-based asset class. So it all depends on how you want to do the allocation. Each individual is different, but that's how typically you should be putting in your money. For equity-based investments, mutual funds is one of the better options that you have, where 35% of your allocation for an aged 35 individual, that's 35% of the allocation of his portfolio, his or her portfolio should be in mutual funds. And again, when you're investing in mutual funds, we typically divide it into different kinds of mutual funds, and there are industry specific mutual funds, and there are mutual funds depending on whether they invest in India or outside, and so many other options are available. But to keep it simple, we can diversify within mutual funds to large, medium and small cap mutual funds. It all is differentiated on the basis of what kind of companies the mutual fund manager is investing in. So for a large cap mutual fund, they would be investing in some of the blue chip companies and so on and so forth. So whatever you pick may be, around 35% of your investments should ideally go into mutual funds. Stocks, direct stocks, around 30%. Now if you're uncomfortable working with direct stocks, you can try out a little bit with small amounts because that's where the growth is. But initially, if you're uncomfortable, you can move this percentage of your investments into mutual funds itself, but slowly you must come back to stocks because that's where your wealth grows. That's where you should take a little bit of risk and let your wealth grow. Real estate close to 15%, and commodities around 5%. So gold, silver, etc. you should not increase their proportion beyond 5, 6, 7% because these are the kind of investment classes which tend to just compete with inflation and don't really offer you great returns to really increase your wealth dramatically. So the key to increasing your wealth dramatically is your equity-based investments and real estate to some extent. Again, depends on the individual how much risk you're capable of taking and how much diversification you're really looking at. But whatever the allocation you have, active portfolio tracking is needed to really maintain the balance of the portfolio over time, because with time portfolio balance will get tweaked. So even if you invested 100 rupees in this percentage and let's say your stocks grow by 30% or 40% over the next 2 years, your balance will get tweaked. You will have more funds in stocks than commodities or FDs and so on, and so you might need to take out some of those and reinvest to maintain these kind of percentages. And with time, of course, your percentage allocation planning will also change, as we discussed that with age you might want to reduce your equity based investments from the current 65%, 30 plus 35 to probably 55 and 45 after every 10-year gap. So diversification is important, and that needs active portfolio tracking. When we say active, at least once a year you should be monitoring how much returns I'm getting from each of my asset classes, how much of my money is allocated to which asset class, what should I be doing to really bring back the required diversified mix that can give me the best risk reward ratio that I'm looking at. So to summarize, while savings and building a portfolio is the first vital step for which we have already studied certain wealth management principles, an unevenly diversified portfolio can hamper the growth of your portfolio, and therefore it's critical that you have the right mix, you have a diversified portfolio, and you're managing it really actively. So we often overlook actively managing our portfolio and we think that okay, now we've given it the right mix, now let it grow. But things change over time, and with growth, and with age, and with so many other factors playing in, and with the liquidity that you may need for certain goals, you might want to continuously monitor your portfolio. Your invested assets in your portfolio are like your employees, and we talked about it in the last module as well, and this is so critical, and therefore we're trying to really drill this. You are the CEO, and if your assets that you're investing in, they're not performing, you're monitoring them, they have to give way to some newer assets who can perform better, and you can know that only if you're monitoring it. So make sure that you monitor your portfolio. The diversification makes very actively. You gotta make your money work for you, otherwise you would keep working for the rest of your life. You gotta do what you love doing, and you gotta let the money work for you, and you gotta make your money work for you. So that's it for this particular module, and you can write to us at help@manoj-arora.com, or you can also visit our website www.manoj-arora.com for any support, any help you may need. Most of the services that we offer are free of cost. See you then. Goodbye.